And we're live. G'day, how you going? Phil Tarrant. I'm the host of the Smart Property Investment Show. Welcome to SPI Live, a live recording of the Smart Property Investment Show, which for many of you tune into a couple of times a week as we navigate property investment, everything interconnected with it. Today, a special episode. You'd be sort of under a rock if you weren't aware that there was an announcement yesterday in relation to interest rates, and the announcement was that interest rates are on the way back up. Who would have thought? We're going to get stuck into it today, try and unpack it, understand it, navigate it, and try and work out what do you do about it. A lot of people, if you tune into the mainstream media, will be thinking about all the problems and issues around it. I actually spoke with my accountant yesterday, and we spoke about opportunities. So I'll give you some sense for how I read that, how I see that, some guidance on potentially the steps you can take to orientate yourself around this particular environment, take action and capitalise, but then also have a look at what the future looks like with some musing from a couple of armchair economists who probably don't know what they're talking about, but I'm excited about this. We're streaming live right across a number of different social channels, TikTok, YouTube, or across Insta and Facebook as well. If you aren't tuning in live, no doubt you can tune into this subsequent to it, and obviously we'll be putting this up on the Smart Property Investment Show. Joining me in the studio to unravel and unwrap all of this, Liam Garman. He's the managing editor of real estate at Momentum Media. You'll know him because he shares the hosting duties of the Smart Property Investment Show with me. Some say he knows considerably more about real estate than I do, and I probably concur with that. He actually quite dialed in with the machinations of government and has a good view on the economy in the work he does as a very skilled and talented journalist. Liam.
Well, the special edition, the interest rate rise special edition of the Smart Property Investment Show live. It's so important we got to do it. We got to do it live. Yeah,
we thought about doing it yesterday after the announcement, but there's just a whole bunch of noise. It's gone up.
Too much is coming through.
Yep. So we know what's happened. So what? Well, let's start sort of pulling it apart now and giving some views and opinions on it. And one thing I'm not scared of is views and opinions. And I need to be very careful in this discussion is that I don't want to say I'm going to limit to 3 times on this podcast. We'll go for about an hour or so with the terms, I don't want to say, but I told you so.
Yeah.
I think it's going to be a little bit about that.
Oh, so much. I mean, that's where all the economic data points, right?
Yes.
And to be honest, and I don't want to be the bearer of bad news, and also this isn't financial advice, but no. I think it's very fair to say, looking at some of the data, some of the inflation CPI figures released only a few weeks ago, I'm also thinking there might be more to come. I don't think this is going to be a one-and-done rate rise. CPI actually increased 3.8%, up from 3.4 the month before. So that was
that's annualized CPI.
Annualized, 12 months to December. So what we're actually seeing is inflation is rising. The trimmed mean's also risen as well, 3.3% from 3.2%. Now, that is perhaps a little bit more of an unexpected rise because the 3.2% was higher because the much spoken about rebates to energy were pulled back. A lot of people thought that, well, maybe 3.2 might be the higher end. The fact that we've gone higher than that, it's actually quite telling about the state of the Australian economy more broadly, the amount of liquidity in the industry, the amount of money going into property in particular, driving up CPI, but also rising energy prices. Those are the 2 key drivers to CPI at the moment. So looking at those 2 things and looking at predicted prices for energy futures, you can tell that energy probably will be more expensive next year than it is today. Looking at all the demand side stimulus that's been coming from the government in housing, it's likely to say that housing will be more expensive in 12 months than today. If those are the 2 main drivers, well, maybe there are a few more rate rises on the horizon.
Yeah, well, you got to look at the historic rate cycles. You know, rates go up and then they come down and then they go up, and normally it meanders over cycles of years. We haven't had a rate rise in 2 years. I think that's the actual number. So it went up to a peak, come back. I think the 3 rate cuts to where we were up until last month, which was 3.6%. It's gone up 25 basis points to 3.85. Now, it's strange. Normally, when rates start coming down, they come down and then plateau and stay that way for some time. And up until the most recent inflation data come out, that the sentiment, my sentiment was, and I echoed it and and it was pretty consistent with people actually know what they're talking about, and those economists, was that it's probably going to be quite steady, the interest rate setting for 2026. Now, the RBA has come out and increased rates. So it's not a downward cycle. It's not even a horizontal side of things. Now, we've had an uptick in rates. Now, historically, when rates start going up, they go up in increments over a period of time. So is this going to be counter-cyclical to anything we've seen in the last sort of known period, last sort of 20 to 30 years, where you're going to get like a sawtooth environment where rates go up and down, up and down, up and down over a period of time as the government tries to balance, so the RBA tries to get its setting right with interest rates? Or is this the start of an upward cycle? Now, if you look at historically, you would assume that it's the start of an upward cycle. I can't see them getting on top of inflation at any point soon. And I think the RBA will probably be cautious and probably hike more than it maybe needs to a point in time to actually get that stability to take the heat out of the market.
We are above the 2 to 3% inflation target band from the RBA. We are enough above it that, yes, it is not unlikely that they will predict further, to hike further. Yeah. And there are a few interesting things here, and I know this is where you and I start giving our opinions a little bit. But, well, it's not necessarily our opinions. We read a lot. So we also...
We also echo the sentiments of many.
We sift through a lot of the information that we're given. Now, the RBA came out and they actually acknowledged that a lot of those price drivers of inflation from the global macro economy actually weren't really felt in Australia. So we were predicting 1-2 years ago that things like energy prices from imported oil would be far higher, shipping costs would be far higher, the cost of imported goods are far higher. But what we've been seeing over the last few months, actually, the Australian dollar is relatively strong, especially against the USD. So the price of goods that we're buying from overseas actually isn't driving inflation as much as we had predicted. So the question, well, what is? Most of the major banks for the last year and a half have been pretty clear. The RBA itself has been pretty clear that one of the main drivers of not lowering the interest rate is artificial government spending. Most of the jobs in the Australian economy are from the private sector. These aren't taxpayers. These are jobs that...
From the government sector.
From the government sector. It's APS. So when you have some of our major banks and the RBA come out saying, well, it's not really the overseas macro economy. It's not geopolitics that's driving price rises in Australia. It's actually the liquidity in the market that should not be there. We are now the only major Western economy that's hiking interest rates. The only one. And it was completely avoidable.
Yeah. Now, I don't want to be too focused on giving the government today a hard time, but I think it would be appropriate to do so to some degree now. The Treasurer, Jim Chalmers, is insistent that the inflationary environment in Australia has nothing to do with increased government spending or manufactured government spending.
Dr. Jim Chalmers.
Dr. Jim Chalmers.
Doctorate of Political Science.
Political Science, there you go. And I think he did his doctorate on some political leader or something or other who was the Treasurer, Keating or something or other. So the government is telling us that they've got nothing to see here with inflation. It's not us. Yeah. It's the private sector is so strong, right? The private sector is so strong. They'll tell us.
So much demand.
So much demand. Now, I don't know. Most Australians aren't economists, right? I'm not an economist. I'm just a bloke who's on podcasts, right? Who reads a lot. And I'm not a particularly smart person, so I see things sort of quite black and white, and I like to think I see things how most Australians would try and understand things, right? So I go, okay, the government sort of told us how well they were managing the economy because they got inflation under control, right? Which they used the very blunt tool of giving subsidised to electricity because electricity was seen the base. Yeah, we fixed inflation by giving people money so they don't have to spend it. That's fixed things, right?
Oh, electricity is just as expensive, but no, you don't feel it. So
don't feel it. So it's okay because the government will pay for it, right? Yeah, we'll fix it. It's all fixed. Nothing to see here. We're all okay. Aren't we great economic managers? We've got inflation under control. If I were the government, I'd be gravely concerned of the situation and the standing that we're in right now. That said, I think it's going to be, unfortunately, very forgiving for the government because we don't have anyone with the weight and the clout to hold the government to account now, other than the voice of the Australian public, who really, do they tune into? They only listen to think tanks and unions, right? So we have a very weak, we don't even have a coalition now. We have a very weak opposition who really haven't got the credibility at the moment to really drive and push and hold the government to account. So they're going to get away with this, right? With spin. They're going to get away with this with, this commentary around this insistent point. Oh, no, nothing to do with us, nothing to do with us. Now, the RBA is independent and needs to be held independent. Whether or not the government holds some sway towards that, who knows, a big question mark around it. But I'd like and I'd hope that the RBA maintains its independence and makes the right decisions for the right settings of Australia, and that's going to be uncomfortable for the government. However, I don't think there's anything that's going to be done about it. I think we're looking down the barrel of a period of increased inflation. I challenge the government to try and get this under control quickly. They're not going to be able to. So what does all that mean? It means interest rates are probably going to continue to, they're not going to go down. At best, they're going to go sideways, but most likely they're going to increase. What does that mean for the Australian taxpayer, the Australian consumer?
Yeah, well, when we talk about, and it is a bit of smoke and mirrors, the blame that, the private sector is so strong. It is so strong that that's what's driving inflation. Recent figures that I pulled up just before, 658,000 new public sector jobs were created since August 2022. Funnily enough, it was in 2022 which we last saw inflation this high.
Yeah.
So now 2 million Australians work for state governments. This is, and not to knock people that work for the public sector that listen to this. That's not the point. What we're saying is you do have a reduction in the pool of people that...
Sorry, how many working Australians are there in Australia, full-time working Australians? Is that 8 or 9
Oh, yeah, I don't have that figure. I think it's in the single-digit millions.
Yeah. I'm going to have a look. Sorry, continue.
What you do have is a reduction in the pool of people that work in the private sector and an enlargement of people that work in the pool of the public sector. Now, it's very clearly noted, if we look at the price of property and rents, which are the biggest driver for inflation. Now, everyone that listens to this podcast, I think everyone's going to know that rents and property prices have gone up quite substantially over the last few years. But that is the primary driver of inflation. So one of the big challenges with this growth in the public sector that we're seeing is you're competing for the same limited number of resources. It's fantastic that we have new highways, and it's fantastic that we have new metros. It's fantastic that we've got new train stations and hospitals. These are all good things for the public service. This is all good things for our amenities, and we love it. One of the challenges that we have is that we've got a trades pool, which is X. You've only got a certain number of tradies. What you do when you have these, and they're not vanity projects because they are quite important, but when you have these government-backed projects which pay more per tradesperson than, say, building new homes, is you take people out of the house building economy into the highway building economy, into the metro building economy. We've seen that the price of building new homes since COVID's gone up 40%. It's absolutely huge. Well, actually, that's the price of construction. That's the price of goods going up 40%.
Yeah.
Now, that's the overseas element. But then you'd have the cost of the trades element going up as well, which is why people just aren't building. So we've got this cyclical nature here where because the public service and government spending on public infrastructure is increasing so much, we're taking away from that pool of trades which could be going to building houses, increasing the supply, which ironically would drive down inflation. But it seems that the way that we're looking to combat that main driver of inflation, which is housing policies, is demand-side stimulus. But the irony of the demand-side stimulus, and I know you've got a lot of views on things like the 5% deposit scheme or the shared equity scheme, the irony of that is it still makes it more expensive. Just because more people can access it doesn't make it cheaper. What you do, and I'll hand over to you because I know you do have a lot of thoughts on the 5% deposit scheme. As a young Aussie, as a millennial,
You're not young anymore, mate. There's a lot younger than you.
Well, I shaved my beard. It was very grey last
nearly
week.
Middle age.
Nearly, but not yet.
Yeah.
I've got a few more years. I see a lot of people, a bit younger than me, but they're jumping on the 5% deposit scheme. And these people are at serious risk of negative equity. With one small blip, we've seen and I love doing this, Phil. If you go on realestate.com.au and you click on a unit in Parramatta that's been sold over the last few weeks and you look at the sales data or go on RP data or wherever you're looking and you'll look at that same sold price 10 years ago and I found one a week ago, which was sold for 60K less in October
Wouldn't surprise
than
me.
10 years ago. So you've got this generation of people that are now jumping on. They're in the lower end, the lower class of assets, or the lower quartile of assets that are less likely to grow, because you will have that element of supply in the unit asset class. So what happens if someone wants to take time off for a child, or you're made redundant, or the Australian economy goes through a shock like we've seen in the GFC, and then suddenly you're left holding this asset which you're paying 95% mortgage on, you've got higher interest rates, and you're going to have to sell. And there is a risk that you will be selling this at a loss. So not only do you not have the asset anymore, congratulations, welcome to negative equity, where you don't have the apartment anymore, but you're still paying the bank off.
Negative equity is okay if you don't need to liquidate an asset and you can maintain
if you do it strategically, I mean, and a lot of our listeners that would listen to this podcast might go into negative equity. You got an eval on an investment property, you pulled out 50K from it and you invest in somewhere else. If you do it strategically, of course, there's a time and place for it. What we're talking about is young Aussies, PPOR owners that kind of blindly follow this 5% deposit scheme that they're going to be paying the price.
I'm really concerned. I've been concerned about it since its inception. I've been very vocal in my views and opinions to it. Just before we get there, just a correction. I was off by about 1 million. There is about 10 million full-time working Aussies. I said it was at 8 or 9, so my number's a bit probably old.
Well,
but that's the number I had in my head. Yeah, it's not
many
bad.
Taxpayers though.
No, it's not. And of that 10 million full-time employed, I don't know how many of them work for the government, but from what I understand, more than 50% of Australians derive the majority of their income through government-related income.
I wouldn't be surprised.
So they either work for the government and or they receive money from the government. So there's more than half of Australians get most of their money from the government. So
hey, I've got a fun fact for you. Just 30 seconds, and we don't need to dwell on it. I saw a stat the other day: 57% of France's GDP is from the government spending.
Yeah,
wild. Who makes the money?
That's why they have, that's why they have revolutions every now and then, right?
Who makes the money to pay? Anyway, I just thought that was a fun aside. But
yeah, no, well, you go out and find these data, and it's all quite fun and interesting. But to your point around the 5% scheme, I just want to start a couple of layers above that. Now, people are probably sick of me talking about this, but I think conceptually it's really, really important. And I don't hear a lot of this from the bureaucrats and the decision makers, whether it's the public service and or our politicians. And this is the collision between some of the national security stuff that I act and operate within alongside of you and housing, right? And this is this logic, and it's really important because I think the Australian economy, Australia is vulnerable at the moment because of this inflationary environment that we're sitting within, and a government which is largely able to do what it wants without the traditional strength and robustness of a Westminster-orientated system which would hold a government accountable. So this is environmentally it's really quite difficult, but this is this concept, and I've spoken about it before, around critical infrastructure, and people hear about critical infrastructure all the time. There'll be fuel security, food security, defence and national security, cyber security, energy security, all this sort of stuff, right? You know, and then you've got like big infrastructure stuff like, you know, dams and roads and all that sort of crap, right? Like this is usually the bucket of critical infrastructure. My thesis is that real estate is the fundamental and most important critical infrastructure that we have, because it's where Australians live, it's where Australians raise their families, it's where Australians promote health and happiness, it's where Australians will hold or generate most of their wealth. It's what sustains our very strong banking system, which is well regarded globally. The integrity and the prudential regulations governing our banking system means it's very strong and resilient. The superannuation industry, which is again regarded globally as a great piece of infrastructure of Australia. This is all contingent and connected to real estate and the property sector. I think 1 in 8 Australians work in and around real estate as a profession. It's what holds. It's the glue that holds Australia together. Right now, which is great. And unfortunately, you have the haves and the have-nots, those people who actually have skin in the game, as in they own Australian real estate, and those that don't. And those that don't are still intrinsically connected within the real estate economy because 1 in 3 Australians rent. So it is fundamental to everything that happens in Australia. Our wealth, our health, our happiness, culturally, romantically, how Australians see themselves. This great Australian dream still exists. So it's a central point governing and shaping the Australian story now and into the future. Now, you start messing with that, you start destabilising the nation. And this is big picture stuff, but you can destabilise the health, the integrity, the security, the safety, the happiness of a whole nation, particularly Australia, if you mess with its housing market. Now, you've had a government which is promoted and supported this nostalgic idea that it's still the right of every single Australian to own their own home, and therefore they've put these policies in place to be supportive of that, as in, don't worry, Mr. and Mrs. or whatever your version of a relationship, Australian borrower, all you need is 5%, we'll sort you out. You get in there, go get yourself a big loan, 95% loan, which I imagine you're probably paying slightly higher interest rates on it because you're borrowing at 95%, to go and buy an asset class, right, that the government decision-making is intrinsically connected whether or not it will be a good or a bad investment. Now, the fact that the government is happy to stump up or back this idea of the 50% gap between an 80% lend, i.e. LMI, says the government's the government, who are the custodian and the steward of the wealth of Australians, is happy to roll the dice on the Australian GDP, the Australian economy, Australia's ability to manufacture money on the housing market. Right, but now here we are with the very real threat that all of these youngish Australians who have subscribed into this scheme at a point in time when they thought interest rates are going to be flat at best or going down in the best case scenario, are going to be stuck with things that they don't want, and they're going to feel as though they've been lied to, and they're going to feel as though they've been let down. And the finger needs to be firmly pointed at the Australian government for creating that environment. Simple. I think the scheme is idiotic. I think it's a good scheme when the wind is behind you, but we don't have tailwinds at the moment. We have headwinds, and I'm very concerned with how that will shape. They need to intervene very, very quickly to shape the scheme, or completely revise it, or manoeuvre it in a way which can be more productive to ensuring the security of Australians. I'd hate to see Aussies. I'd hate to see a generation of Aussies who are already struggling with the cost of living, who have been told by the government, we're going to get involved here. No more high debt to income lending because that's what's fueling, rapid price growth. That's what's fueling the cost of living crisis for everyone else. So you can't do that, but all you over here, here you go, 95% lends, get into the market, happy days.
But you'd think they're mutually exclusive, right? And the irony is, right, behind this, so if you go up to $1.5 million in Sydney with the 95% lend, if you're clearly not a low-income earner at that point. But what you do have is an inability to save, or a demonstrated inability to save. Now, not everyone will do that. I'm sure a lot of people came in on the 5% deposit scheme, so they put more money in their offset. Maybe they're being a little bit strategic. And
no, they're not. Mate, everyone's borrowing the maximum.
Some might, but for those who are borrowing the maximum, you do have a demonstrated inability to save, which is why you do have things like higher interest rates. But that's the intrinsic risk that we've subscribed to as a nation. And there has to be a pretty frank and fearless discussion about this, because we have to stop telling young people to just get on the ladder, which I think is...
But by the way, a lot of these young people are in their mid to late 30s buying their first homes.
They are.
Not so young. This glamorous idea that 21-year-old people
it's done,
getting married and having kids at that age, yes, it's some people, but not most.
Now, I think we as a nation can have our cake and eat it too, but it just takes a little bit of rethinking. And now rethinking that old mantra of get on the ladder and slowly work your way up, well, it doesn't actually really work like that. You know, if you bought that unit in Parramatta 10 years ago, you're actually not in a place where you can slowly work your way up to a house.
So negative equity 10 years later is your example.
Well, that's I think that's a fantastic example of the old adages of you just almost buy and work it out later because it's always going to increase. It's not necessarily true. So we have to have a frank understanding as a nation to just not on a whim just buy a house or buy a unit. Don't do it on a whim. You have to think. You have to think strategically, and I think we've really set a few people up for a really dangerous circumstance.
It is.
And one other thing, Phil, that I should have said before. Not only do you have the risk of negative equity, you've got all the costs associated on the way out. What, a 2% selling a listing fee?
Yeah.
You've got all the conveyancer fees, everything associated with it. You know, you might have a generation of young people completely lose their money. Also, there is that misalignment between state and federal governments. So, and you and I were talking about this before we went online. In Sydney, if you buy at that 1.5 million, that's 700, 600 grand above what the stamp duty exemption is. So you're still paying stamp duty on it. It's not like you're just getting in for 5%. You're still paying significant transaction costs in and out for something where you might have that old property advice of just get on the ladder and sell it in 4 or 5 years and it'll double in price. That's not necessarily how this is going to work.
Yeah.
And there's going to be a generation of people severely and bitterly disappointed, which ties into your point about the security as a nation. You know, if you've got a disappointed generation out there, or a generation, if we walk into another GFC tomorrow because there's a trade war or whatever, you know, there could be 1,000 scenarios. It's bad.
You don't want to be going into tougher times when you're fragile. So it's really important conceptually, right? So if there's going to be tough times ahead, you want to be as robust and resilient as possibly can. If you've set up a huge cohort of your population to be vulnerable at the point where it really matters, and that is the security of where they live, that doesn't bode well. And this is important. You look at, you know, the divorce rate in Australia, it's quite high. It's consistent with the Western world. When you look at a lot of the reasons for divorce, you know, or relationships falling apart, a lot of it is financial stress. You know, it's either mortgage stress, financial stress, misalignment in views towards money, or fundamentally just not having enough of it. You know, it can rip apart and fracture society very, very quickly. And if you're going to exacerbate that with poor decision making prompted or propagated by poor policy, which is a responsibility of the government, got to be held accountable. Absolutely need to be held accountable. However, I don't think we're in an environment where that's going to take place.
Well, the government's also getting into the property buying market now. With the
shared equity scheme. Don't start me on that. Like me as an Australian taxpayer, I think it's...
Well, you as an Australian taxpayer own a bigger portfolio than you realise.
I know.
Technically speaking, you know, if you've got 10,000 people a year, that can get up to 40% equity.
Every Australian taxpayer is a property investor now because we're co-investing with certain cohorts of Australia.
I'm sure we're all going to see the dividends.
And again, you know, like, and I'm not that familiar with the policy, but from what I understand, certain people can club up with the government. And again, I'll simplify this because I'm not that bright. So, yes, Mr. Government, let's go and buy a property together. I'll own 60% of it. You own 40% of it. Yep. I'll take a loan for my bit. You stump up the rest. And because property always goes up in Australia, at a point in time, I'll refinance it. I'll pay you back. And or if I have to sell it for whatever reason, you get 40% of the uplift. What a great investment for the Australian taxpayer.
Yeah,
that's brilliant, assuming that the property market... That number one, the property market historically performs as it has done. And number two, that the property that people are buying are actually those properties that do go up in value. We've got a podcast, we've been talking about it for 10 years on the Smart Property Investment Show, about where to put your money to get the most capital growth. A lot of places don't grow in value, and some asset classes, residential property is what we're talking about here, just don't grow.
Did you know 53% of new build units in New South Wales have quote-unquote major defects?
Oh, it wouldn't surprise me.
Since 2016. It's huge.
Wouldn't surprise me.
It's huge. So if that's the asset class that people are going to be buying into, you as a taxpayer, you're buying something that might actually just be a liability in the long run, right?
Yeah. So it's all a bit stuffed, and I'm really concerned and worried about it for our current generation and future generations in relation to home ownership. It needs to start a sensible conversations around education around Australia about what home ownership looks like and the realities of home ownership in Australia moving forward, particularly if you want to live in the capital cities. You know, you hear adverts on, you know, the radio going, move to regional Australia. Regional Australia is great. Yeah, I absolutely encourage and support that. I think that's great to provide different ways of living for Australians, which may be more within their means from a structural point of view and the money that they generate in terms of income. So the government has a mountain to climb right in front of itself right now, and this is getting inflation under control. And I imagine there will be folks down in Canberra, you know, political operators, you know, Treasury, you know, think tanks and very smart boffins trying to work out what next scheme. What's the next scheme we can put in? That's schemes can have negative connotations, right?
I think we unpacked that before.
Yeah, we did.
Scheme.
So what's the next scheme? How can we alleviate the cost of living for Aussies right now?
Well, with the 5% scheme,
that's not inflationary.
Not inflation. Well, what was it? They predicted it would only increase house prices by 0.5% over the course of like 7 years or something.
Yeah.
And
The Treasury modelling around the 5% scheme you're talking about.
The same people within the first month, in October alone, and this is where you miss the human element of it, right? In October alone, 5,500 people took that up. 5,500 people. And you and I speak to brokers, BAs, estate agents. You and I speak to them every day. In the few months leading up to that scheme, because the government pushed it so hard and every MP was out there, Chalmers was out there, the Prime Minister was out there talking about how good it is for affordability for young Australians, and the argument being, you know, you get out of renting quicker, da-da-da-da. And we had... I'm not sure what your conversation had. I had every broker and BA and estate agent that I'm talking to. Oh, yeah, our phones are going off because everyone's getting FOMO. Every investor knew, well, not even necessarily just investors, every Aussie knew. It was like, oh, you know, this is going to be so inflationary the second October 1 turns around. I better get on board now. You miss the human psychological element of herding into investing. Every investor realized, oh, this is going to be so inflationary. Yeah, I better get my settlement done before October 1. Whether it was right or wrong or not, it's not our place to comment, but there were a lot of people entering the market for the sake of it.
Yeah. Yeah, because I thought, oh, here we go. Like, if I was a young person looking to buy my own house, would have I done that? Probably.
I rushed a settlement through, we got through September 11th, a bit of an ominous day, right? Yeah. But I fell for it.
Yeah.
You know, I fell for it.
So the issue is that we're only a day since this announcement's come out. The realities of, you know, the next... You know, the banks come out straight away saying they're all passing it on.
The main ones have.
They have done. See,
I'm with non-majors.
Okay.
So I'm waiting for the
and we'll get into this in a moment. So let's assume that everyone passes on the interest rate increase, right? So you've got a month until you're going to work it out, right? What I'm intrigued to see is when this thing actually starts snowballing. It might not be the first month, might not be the second month, but, you know, and let's assume that if interest rates keeps climbing, in 6 months' time, 9 months' time, and you've got this cohort of Australians who find themselves, well, whether the 5% scheme or otherwise, despondent about their lot in life and start looking for accountability. And one thing which is the bedrock of democracy is accountability, and I want to see how quickly the government's going to put their hand up saying we've made some wrong decisions here, whether they unwind it or not, or there'll be talk about compensation. Like, who's going to help out these young people? You know, remember your pink bat scheme, which is a bigger thing, right? It's going to be like, we put this scheme in place. It didn't work that well. I think the pink bats was horrible. There was kids dying in roofs. It's like 12, you know, a huge amount of accountability.
Like 12 tradies died or something. It's crazy.
Absolutely appalling, right? You know, because it wasn't delivered the right way. Who's going to compensate these Australians who have subscribed into a government scheme which has been ineffective and put them backwards rather than forwards, right? You watch what happens. Yeah. You know, there's going to be a lot of finger pointing. People are going to go, oh, the mortgage broker, I only wanted to borrow $400,000, but my mortgage broker told me to get 1.5 because that's what you can borrow up to, or whatever the number is, and I didn't really want to take that much. And, you know, you're going to get scapegoats, 100%. You're going to get finger pointing, and it's going to be intriguing to see how that plays out. But unfortunately,
But that's
we're looking
but
at a
that's what I
barrel
was
of
saying
some
before.
problems.
You know, some of the life lessons. Now, you would have heard all the life lessons. I heard all the life lessons about get on the property ladder sooner. There is also a life lesson of borrow as much as you can.
Yeah, that's what people do.
That's
You
what
try and
people
get as
do.
much as you can.
Yeah.
That you're trying. It's all about serviceability, right? Try and get as much as you possibly can, on the assumption, the basis that
It's going to go up.
you put it in a market, you're going to get upside on it. So this is a moment in time. I want to urge caution and sensibility. It's like, economists are saying most Australians should be able to handle a increase X, Y, Z.
Oh, look,
there's still a huge amount of savings in offsets, and they're saying it can be absorbed.
Well,
so there's got to be two sides of this, right? You've got this first home buyer stuff, and then you've got everyone else who have been conditioned of paying higher interest rates up until a few months ago.
Well,
anyway.
I would say this is where generationally there's a lot of really interesting research done by some of the major brokerages on where pain's being felt. And I think the simplest way to describe this, Phil, is, in today's housing market, a $900,000 to even $1 million house is actually, for a house, not that bad, right? It's not that bad. But you know when it is bad? When you have 95% mortgage. That's when it's really bad. Yeah. Now, what you do find with most consumer confidence is if you bought basically before 2022, you don't really notice too much. As long as you haven't had any really destabilizing effects on your personal life, losing a job or a partner taking time off for children or whatever it might be, you're more or less okay. Now, not all the time, but more or less. So after 2022, there's this huge gap, especially driven by, if you were kind of driven by the FOMO in, say, Brisbane, and you saw 20% year-on-year rises in your postcode and you got in right at the peak of it, then you're actually kind of hurting a lot. And it's those people that, again, a $900,000 house might not sound like much, but when it's a 95% mortgage, it is. And if you stare down the barrel of, even if it's a 1% rate rise, you're probably already paying a 6% interest rate, right, as is. You're going to have people staring down the barrel of high sixes. That's painful.
If you're not used to it.
If you're not used to it. But,
or you don't have the capacity to cash flow.
I would say if you were used to it, you would have bought 3 or 4 years ago when there were high rates, but your asset price would have been lower. Yeah. What you're doing is you're buying the asset at the height, and then you've still got the higher interest rates. It's a double up.
Yeah, so I think there's two sort of cohorts we're talking about here. There's with mortgages that have been with a mortgage for some time, or property investors, and you've got this 5% stuff. And I think we've done the 5% stuff. We can move on. We've
unpacked it.
We can move on from that. Yeah. I would encourage the government to roll that back very, very quickly, and or completely change the mechanics of it. That's what I'd be doing, and I'd certainly be looking at the shared equity scheme. I don't. You're creating a false floor of home ownership, and I don't think it's the obligation of all Australian taxpayers to be potentially putting people in situations where they shouldn't be. So government's got to get real with this. And we'd be happy to go and chat to the government and give them some views and insights on it. But they typically don't let people like us have a voice, because we're not bureaucrats in the public service who are lifetime bureaucrats who don't operate in the private sector. So.
Well, the grandest irony is if you want to take advice on how to lower interest rates, how to lower property prices and lower inflation, maybe speaking to an investor is a good way of doing it. Yeah. Because if an investor's like, well, I definitely don't want you to do that because it might impact this, then there might be some sage advice in that.
Yeah. So this is the great irony, or the great dichotomy that myself, you, and other property investors are faced with, and that is, despite all the things that I've said and how this is undermining and it's putting Australians in a lot of tenuous situations and it's not great for the economy, et cetera, on one hand. On the other hand, and this is a live stream, is a show for property investors, what you're talking about is how do you exploit it for your benefit. Let's look at it in this way, right? And hence the reason why property investors are often demonised by cohorts of the Australian populace or population. I think our producers sort of coming in with some questions and stuff here, so you can do that, and please keep it in. Remiss of me. We were going to start doing these lives, but Jacob, what have you got for us, mate?
So we've got a viewer here who wants your thoughts on the Super Saver scheme, where utilising superannuation to help save for a house deposit. Is that a good scheme or a bad scheme in your opinion?
Okay.
How's it fit in with the current rate hike environment?
Okay. Wow. All right. Well, I'm not an accountant, not a financial planner, and I have no licenses whatsoever about anything whatsoever. What I would say to that, I don't know what your view is it's okay, and I would recommend everyone does this. Do it the old-fashioned way, like, save your money, budget well, curb your lifestyle, get a deposit together, and buy within your means. I am reluctant to champion these sort of more fringe type scenarios where you can do X, Y, Z and save some money a different way and get it matched and whatnot. Like, it's best to do things the old-fashioned analog way, and that's how I approach most things in life. The 5% scheme, I think a lot of people have been pragmatic and they've just gone, hey, this really aligns well with my timing of buying a house, and I've got this scheme in front of me. Super savings scheme. My view on super, it's a secondary, third consideration for me. It's not something I'm really sort of subscribing into having any relevance to my retirement plans. It's just something that happens in the background around it. I think it's very good for more run of the sort of norm Australians, which are on a traditional trajectory with retirement. However, they're the sort of people that typically don't tune into the Smart Property Investment Show. People who are tuning into this are active around it. So I'd wonder where that question come from, because it sounds more of a first-time buyer type, or I might be struggling to get into a market, versus hey, I'm a property investor looking to grow a portfolio.
It is a scheme designed for first-time buyers.
Yeah.
It's just another way where they can lock savings away in a high return environment, rather than just a simple savings account.
Again, I always sort of query this sort of stuff, and depending on the government of the day, you've got there's a big fracture between the superannuation regime in Australia, where you have your traditional superannuation infrastructure, which is retail or industry funds, which are run by superannuation companies, and then you've got self-managed superannuation. And a lot of the schemes, you see this playing out, and you only need to knock around Canberra a little bit, and you'll just see the strength of the lobbying mechanisms of some of these superannuation industry, to try and get people to put more money in super to lock it up. Because the big question is that, the more money in traditional superannuation, the more money that the superannuation companies generate and the returns that they make. Now, that's a good thing in that, Australians hold their money in superannuation, so they want the biggest returns they possibly can do. But I'm always I always question whether or not putting your savings into your superannuation as a savings scheme, that money could be better deployed elsewhere. But I'm not a financial planner, and I can't give that advice. I don't know what you think, Liam.
No, my sentiments exactly.
Yeah. So I like to do things the old-fashioned way, which people think I'm probably idiot around. But so, any other questions coming in? Just send them through. As they come through, let us know. I hope that sort of answers. I don't want to be vague on that, but I would encourage you to speak to your accountant.
Well, we
your
might be able to do a
financial planner
podcast on it later. Maybe we can ask one of our who asked the question.
I'll just do
Anonymous user,
and they're probably going to think that it was a bit of a throwaway response to me.
That's
but
right,
that's not really. If you're a property investor looking to grow a portfolio, build a portfolio as a property investor, you might, that's more of a first-time buyer type scenario. You can pick up maybe on the stuff that you do.
Yeah,
there.
we can definitely unpack that further for a non.
So where I was at was this reality that, that you've got to be comfortable with the hard truths of being a property investor, in that you live in an environment. We spoke about all these really important structural, philosophical aspects of living in Australia, being in Australia, the cultural connectivity we have around property, and how we're sort of navigating that in a sort of the modern environment, running in parallel with the fact that we're all trying to make money out of property as an asset class. And that's sometimes an uncomfortable truth. The reason why you have a lot of pushback on already unions saying, hey, just because interest rates are going up, property investors don't take that on the Australian population by increasing your rents. This is third, fourth order consequences.
Phil, and you and I have been, I think, fairly consistent on SPI with this, which is your and my opinions on the 5% deposit scheme, and not to beat that up again, but it is from an ethical point of view. It's from a very moral point of view that we just don't want to see young Australians really locked in danger. And it is coming from from our own, not from our own best interest, but for care for other people at the end of the day. And I think it's very fair to say for a lot of investors, you don't want to see this up and down growth. You want predictability in the market.
Yeah.
There's no point a market going up 20% only to drop back 20% the next year. I don't know where that math ends up, whether you're plus or minus, but you need some level of predictability. The challenges with these schemes with the property market is that actually, yes, it is inflationary, and yes, it is good for investing in the short term, but what it does is it does create a whole level of unpredictability, because if we now look down the barrel of several rate rises, well, then that's where we start getting into murky, uncharted territory, especially looking globally. We're the only people doing this. So we are doing it for the right reasons, and we do want smart, stable, predictable growth.
Yeah, it's a question of sort of morality, right? You can sit there and say, hey, I really care about Aussies doing all this stuff, and I generally believe in it. And I would counsel and caution my children and friends of children around these type of things. You know, you've got to be... You know, it's you've got to tread carefully if you're looking to enter the housing market, whether you're an investor or owner occupier, and you need to be responsible and accountable for your own decision making. You know, and this is absolutely critical. But so we sort of have a high inflationary environment. We have one rate rise yesterday, and the likelihood of another one. It's questionable right now. We need to see how it washes out. If you look at the commentary from the Reserve Bank governor, she's gone, well, I'm not saying there's going to be any more interest rate hikes. However, if inflation remains sticky and where it is right now, we may need to raise rates again. So the conservative person in me, and I'd be championing this sentiment to everyone, expect more rate rise.
But hey, can I say,
plan for the worst, hope
how
for the
lucky
best.
are we? How lucky are we to live in a country where we do have independent decision makers? And we saw it with APRA. And again, you know, whether it hurts our back pockets now or not, but how lucky are we that we do have these? And I know we were smashing bureaucrats and APS before, but we have these independent people that can make these calls without bowing to political pressure. Because I'm sure if a lot of politicians had their way, they'd be trying to nudge it down a little bit, and then who knows what level of pain we might be in the future.
You don't know, and unfortunately, the electoral cycle here in Australia means that most of our politicians only think with a view to 3 to 4 years, rather than, you know, you to have bold, ambitious leaders who are talking about bigger picture issues normally get knocked down on the head pretty quickly and sanitised. So, you know, I'm not beating up the government or the public service. I think they're a very important part of the institutional engine of Australia, and they do great work. They don't always get it right. That's okay. But we need that. We need someone calling the shots and making these decisions, right? But this comes back to the point. What's going to happen to property markets as a result of this? Now, the natural reaction for a lot of Australians is to be concerned, and some are quite alarmed. I wouldn't be alarmed. I'd just be alert and configure yourself. Potentially, we're only talking about a 25 basis point increase, and for most property investors, if that's going to, you know, completely change the narrative of your property investing journey, you're probably a bit vulnerable already, and you need you got a lot more issues than a 25 basis point interest rate rise. But I think the brakes for a lot of buyers, even investors, will be tapped. I don't think they're going to apply them strongly, but they'll tap the brakes for a period of time and see what happens with the interest rate environment moving forward. So you're going to have a period of time, I think, where you may have less buyers in the market. I think the shine's going to be worn off the 5% scheme for a period of time until we get an understanding of what happens, which means there'll be less buyers in the market, or there'll be more caution. Therefore, they may not be bidding or buying up to the points where they would have traditionally done so, because hopefully they've spoken to a mortgage broker and worked out exactly what the realities are of a high interest rate environment, and they may buy cheaper properties. And the 5% scheme largely is where a lot of investors operate as well. So I think they're going to have a period of time, because of the uncertainty and the state of the economy and the state of the inflationary environment, where if you're a motivated investor and a motivated buyer, you may see opportunity in the market. And that's the way I frame it and view it right now. And that was my discussion with my accountant.
And I think that's very sage, wise advice. what I think it's important to understand is these levers. Raising interest rates doesn't necessarily cleanly equate to lower house prices or lower rent. It doesn't cleanly equate to that. As you highlighted, probably $100 a month, quite minimal if you're a smart investor. What it does mean though is we are already at record high insolvencies for builders. Record high insolvencies for builders. And what, you and I dabble in the mortgages space as well. What we know, a lot of builders with SME loans and SME mortgages, they're not necessarily through major banks. They might be through non-bank lenders. They might be through private equity. And what might be a 25 basis point rise from the RBA might actually translate to a 50 basis point rise for their private loan. We might see, and we might be looking down the barrel of restricted supply in the future as a result of this, just as insolvencies start tracking up as well. And I think we got another question
from a guy called Chris. He's
Chris.
an inspiring investor currently renting, but he's worried about the rate hike being passed on to him as a renter, inhibiting his ability to potentially become a rent investor.
Yeah.
Do you have any advice?
Yeah, it's a good question. So if you didn't hear that, an aspiring investor concerned about the interest rate rise, meaning that his rent will go up, which will slow down his ability to earn, to save money and therefore enter the market. It's a really good question. So fortunately, or maybe less unfortunately, it depends who you speak to, there's been a lot of structural changes to rental laws right across the nation. And most states now you can only, or maybe all states, most states, you can only increase the rent every 12 months. And which means that, you've got some certainty depending where you are on your lease. I would be assuming for most renters that every time that 12-month comes up for renewal, expect a rent increase because we're just in that market right now. But it'll be proportionate essentially. So, there's the market will determine what the rents are in any particular area. So if that is a concern and you're a renter and you're concerned about increasing rental costs and you're aspiring to be a property investor, you can either move faster to enter the market, and there's a number of different ways you can do that. I'd be looking for potential guarantee loans, higher LVR lending, all this sort of stuff. Speak to your mortgage broker because you may be able to enter the market faster and or enter the market in a market where you may not have been thinking about before in a cheaper market. So there's ways in which you can do that. And or move to a cheaper rental accommodation so you can maintain your current saving levels. This is the realities of Australian rentals in that with a third of Australians renting, 95-ish% of that, again, I might get the number wrong, of rentals in Australia are owned by private landlords. It's a reality that the market will dictate the market, and this has been one of the criticisms of rental reforms is that how can you say that you allow the market to determine interest rates and prices, which is just the natural organic nature of how markets operate, but you're restricting it from one core aspect of it, and that is the way in which that real estate is rented. And that's the governing structure put in place by state governments in relation to these rental reforms. So again, you get the government dabbling in these areas, manipulating the way in which things work. And it's this sort of cake and eat it type thing as well, going, no. We're not going to stop banks from increasing interest rates for property investors. However, we will stop your ability to manufacture more money from it because we'll put rules in place with how you can do the rentals.
And one thing I will say to Chris, and obviously not financial advice, but it's not a license to rush.
No.
If you might need to cop the bruising of a $20, $30 rent increase. I can't imagine it'd be much more, but again, I don't know the circumstance. But it is not a license to make a dumb decision because you get FOMO. That's what we saw before when we were talking about the 5% deposit scheme. Again, all roads lead back to the 5% deposit scheme on this podcast. But we saw from so many of the BAs, brokers that you and I speak to on a daily basis, I heard so many people say, actually, especially on the broking side, how many people are rushing and making dumb decisions to get in and settle before 1 October, before the first home buyers are coming in, because they get this FOMO, that fear of missing out. Because from October 1, property price is going to sky. Well, yes, it was inflationary. They didn't go up 10% overnight, right? It was modest, and it does take months and months and months for this stuff to come through. It can take months to get pre-approval depending on what your situation is. You have 3 months to use your pre-approval depending on what your situation is. It does take time to leach into the market, but go back to the basics of an area, an asset class, which is going to work and going to work for you, going to work for the long term, going to work for your financial situation. Don't go in and buy a suboptimal asset for the sake of it.
Yeah, don't rush into things. And back to your point around negative equity, there's people buying apartments 10 years ago that aren't worth what they
pay for.
What they pay for right now. And what was your stat around building defects, major building defects?
53%.
You know.
Yeah.
So be careful about what you're buying. You know, and it's a complex, complicated environment you're operating in, buying property in Australia.
You know, if it takes 1 or 2, 3 months to have a lay of the land, to understand, if you're using a BA, fine. If you're not, upskilling, learning different areas, learning whether an area you think hand on heart, the economic fundamentals are there to go up or not.
Yeah.
Take the time.
So conscious of time, Liam, I want to round this out. So let's put things into perspective.
Mm-hmm.
So the immediate perception of things based on yesterday's rate announcement is, everything's stuffed. The economy's in a woeful state. Inflation is going to cripple Australia moving forward. Interest rates are going to rise. All these really bad things, which means that you shouldn't do anything. You need to sort of batten down the hatches and wait it out, right? So like that's a lot of people's.
They're wrong. They're wrong. You know,
would be their view right now. So that's a perception. So let's put it in perspective.
Yeah,
right?
There are postcodes up and down the country. You know, if we take Brisbane, for example, where we saw the explosion in asset prices and rents as well. If you've been listening to SPI for a long time, you would have gotten a lot of the inside scoops years above. But a lot of these areas have become positively geared super quick. Yeah. You know, there are a lot of investors out there that I reckon a 1% rate rise for some. If you had a mortgage on a place in Logan that you bought 6 years ago for $150K,
you're doing okay.
You could have a series of rate rises and you'd still probably be positively geared, right?
So 2.3 million landlords in Australia, half of them, from what I understand from the stats, are negatively geared. So a half of all investment properties are positively geared. Now let's assume a lot of them don't even have debt on it.
Yep.
So this is about putting the perspective, right? A lot of them don't have debt on it, and of those that do have debt on it, a lot of them are positively geared, right? You know, so things aren't as bad as what you can probably wrap yourself up in a frenzy to think and believe. So it's business as usual.
100%. And you know what? I'll give a little bit more colour. You and I were talking on the phone on Monday, I think it was, and we were talking about capital gains tax and some whispers. And this is a whole different podcast, so not to take too much more time, but this is where a lot of people default. And I thought it was fantastic, a fantastic focus group I held with my wife. And you and I were talking about the unions pushing for a cut to the capital gains discount. So essentially you're going to be paying a bit more on your capital gains tax. And I said to my wife, I was like, maybe should we put a hold on the after we get our next property, should we just have a breather for a bit? And she's like, no, I don't think there's going to be any problem there. Landlords are just going to hold. And then it triggered this thought of, well, if you do even tinker with things, say like capital gains tax, where the transaction costs on the way out rises, you're probably also just going to, it's not doom and gloom for landlords. You're probably just going to get to a point of people like, well, we got no inheritance tax in Australia. I'm just going to hold it generationally from now on. Done. Which means listings will probably decrease, right?
And which will put more pressure on property prices,
100%.
et cetera, et cetera. So
that like from that one sentence from my wife, I was like, oh yeah. And then I started doing the maths. I'm like, well, if we just hold and then it just becomes an inheritance thing and it's generational and then we just pay it down, Because at the moment I was going through, working with our strategy and how quickly we sell and redeploy capital. I'm like, well, then we just don't sell. And
this is the point, right? So putting things let's put things into perspective. So my message here is nothing to see.
Yeah.
Nothing's changed. Yep. Yeah, we might be in an inflation environment. It might be a period of time where interest rates go up. Okay, great. This is just doing business in real estate. So put it in perspective. The economic system is intrinsically connected with the health and integrity of the property market in Australia. Okay, so you've got a lot of very interested parties to ensure that sustains. The banking system in Australia is intrinsically connected with the mortgages it puts against property markets in Australia. Our banks are pretty good operators. They've got a big stake in this thing. The superannuation sector, which is regarded globally, is intrinsically connected with the property market in Australia because most of the superannuation funds hold a lot of stocks and shares, and therefore most Australians are in either real estate itself and or the banks that finance it. Okay, you've got another big invested partner there. The Australian government is a property investor co-investing with Australians and has built its tax system around ensuring that Australians are the primary landlords providing rental accommodation for Australians. So you've got pretty much every core aspect of Australia's infrastructure directly connected with ensuring the health and integrity of the Australian property market. So
100%.
That's putting things into perspective. Nothing to see. Business as usual. Get on with it. Don't let anything happen really with interest rates or blips in interest rates to change the way in which you should approach property investing in Australia. So that's my sentiment. What does it mean to me? Nothing. To your point, capital gains is only an issue when you realise the capital gains. Now, I know the government was sort of having a crack trying to
For super.
for tax unrealised capital gains inside the super fund. Will the government in time say, hey, we need to start taxing the unrealised gains of property investors in Australia? They're not going to touch it. I think it's such a tenuous issue. So don't make your property investment decisioning around not buying because you're worried about maybe the discount on capital gains to be halved or whatever it is. It's irrelevant. Half Australians are negatively geared. All that'll happen is Australians will take on more negative debt as long as assuming they can service the debt. You can't tax debt. Yeah. And the taxation system in Australia is built around negative gearing.
If you're negative geared, just an extra shift at work. Done.
So cut the noise, press ahead, be aware, be informed about what's happening with the economy, be informed what's happening about interest rate, but largely, unless you're sort of really redlining, just factor it in. Just factor it into your decision making. That's my view. Jacob, you got another question?
Not a question, but more of a statement.
Someone telling me I'm an idiot? Yeah.
So he disagrees with your negative sentiment around the first-time buyer scheme.
Okay.
For the sole reason that he used it smartly, bought 6 months ago using the scheme.
Yep.
And he's already 4x the equity because he bought in a smart location.
Yep.
Is he saying he doesn't agree with the negative flat advice of no?
I'll take this one. I'll take this. Sorry to cut you off, Jacob. And who was our commenter? Harrison. And I think that's fantastic. But we did start off at the beginning of the podcast. There are times and places where you can use it smartly.
Yeah.
And we said that, and I know examples of people that have used a 5% deposit scheme, held stuff in their offset, and then they've used that money from the offset to buy an investment property. There are ways that you can do it smartly. That's not financial advice. That's what I've seen people do. For that exact example there, you also intrinsically rely on living in a quote-unquote hotspot. Now, I try and avoid that term because I think we overuse hotspot, and it also leads to kind of dangerous speculation. For sure. Like if you use the 5% deposit scheme and you're in Perth, fantastic. You probably have done really well. Or maybe not all areas of Brisbane now, but some of the pockets of Brisbane that are still growing, maybe lower quartile. Sure, you probably have made a bunch of money. Yeah. Melbourne, maybe. Sydney, probably not. The average house price in Sydney's gone up a couple of %. And if you're in maybe an oversupplied asset class, like we were highlighting before, the unit class in Sydney, probably not. The 5% deposit scheme also relies on that element of luck, that you're buying a PPOR in a location that's growing. Keep in mind, 5% deposit scheme can only be lived in. Yeah. You can't invest it. You can't say, well, I'm in Sydney, I'm not going to buy in Sydney, but hey, there's this growth pocket in Perth that I'm 100% sure is going to grow in. I'm going to buy there with my 5. You can't do that. So there is that element of luck. Harrison is correct. You can do it. Luck. There is geographic luck. Harrison is absolutely correct. It can be done. But I would say that that is 1 out of 100. Yeah,
I tend to agree with you. And what I would say to Harrison, it's a fair and appropriate comment. The fact that Harrison is spending his Wednesday lunchtime tuning into SPI Live
Yeah.
would
Yeah.
tell me that he's invested in educating himself. He's
Yeah.
probably thinking like a property investor, and he's probably been pragmatic enough to go, hang on a second, I can get into the property market with 5% in an area which is going to be growing in value. And from what I understand, in order to get most of the government grants, I'm not too sure on the 5% scheme, you need to live in the property for 6 months, for 6 months or so. So, mate, yeah, you've played the system well, like I would say. You know, like you've done it all. It's all appropriate. You've got the uplift in terms of equity. You're probably turning this into an investment property now that you've satisfied the regime around living in it for a period of time. You'll probably refinance that now, maybe back down to 90% lend, turn into an investment property, redeploy that money elsewhere, and you've used a government incentive in order to get yourself into the market and a point from which you can
Make it work
extrapolate
for
out.
you, yeah.
Brilliant. Great. And a lot of people do it in other ways. So people might do a family pledge to start with to get into market with a 5% thing, you know. So all these things are possible. So, yeah, not disagreeing with you at all, Harrison. It sounds as though you've really understood this and you've played the advantage.
Maybe Harrison needs to jump on a podcast.
Should do.
Yeah,
That's cool.
The first property buy show.
Anyway, so in summary, just get on with it. Don't worry too much
Business
about
as
it.
usual.
Business as usual. Business as usual. You know, fast forward 6 months. Most property investors, a lot of this is just largely irrelevant for them. It might just change their decision making a little bit. Don't overinvest. You know, have your own appetite in relation to risk about how much you're willing and what your satisfaction levels is in terms of how aggressive you want to be with your borrowing and your investing and your buying. It's probably going to be determined on where you are and what stage you are in life or level of maturity. But there we go.
Fantastic.
All right. So we'll keep an eye on this, see what the government does.
Watch this space.
Watch this space. There's a lot of other ways young Australians can get into the property market without having to subscribe into government incentives. And I think the bank of mum and dad these days is one of the second or the third biggest borrower
Pretty much, I think.
in Australia.
Yeah.
So if you're looking to get in the market, you don't have to buy a principal as a residence to live in as your first investment. And you're seeing now one of the reasons why APRA's come out and this sort of higher debt to income ratio lending is because, was it 40%? I think 40% of all loans in New South Wales originated in maybe November was for investors.
For investors, yeah. Like
I think
42 or something.
yeah, 42. A lot of investors,
Yeah.
a lot of first-time buyers are investing.
Oh, yeah.
Why not?
Why not?
Live with mum and dad, get them to cook your dinner, clean your clothes, stay there as long as you possibly can, build a granny flat in the backyard, get out of the
Easy.
house. That's it. And if you're a young investor, there's a lot of alternatives to all this. Speak to a mortgage broker. I would recommend. There's lots of really good ones out there. I use Finney Mortgages. They're a good operator. Get stuck in. Thank you, Liam.
Oh, thanks, Phil.
There we go.
Thanks for having me.
Some rambling musings around the health of the. What's going to happen? What's going to happen with the current government, Liam? What's going to include with this?
I'm not going to. I've looked into my crystal ball too much today. And I don't want our listeners to pull me up in a year and talk about all the stuff that I got wrong. But you highlighted before, and you're right.
I get lots of things wrong.
There's no opposition anymore, really. So
No. I don't know what Pauline says about all this. What's she thinking about
I don't know.
housing?
I don't even know.
Maybe
Do they have a housing policy?
Let's get her onto the podcast.
Well, if Pauline's listening,
yeah,
please
I'm
come
sure.
on.
I'm sure
Yeah.
Pauline's people, would be.
if you're
tuning into this.
Pauline's person,
yeah, we'll
Yeah.
do that. Where's she?
Queensland, Logan,
Queensland
or something.
somewhere,
Yeah.
There we are. Different voice, different opinions around it all. And for those people sort of tuning in who may be part of the bureaucracy of Australia, happy to have a chat with any interested body and or politician who wants to have a reasonable and informed conversation around property investment in Australia.
Absolutely.
Contact you.
Liam.Garman, Garman, at momentummedia.com.au. We'll have the chat.
There we go. Let us know what you think. We'll do more live streams. This sort of time sort of works on a Wednesday, I think.
Let's
probably
lock it
better.
in.
We were thinking about Fridays, but let's do Wednesdays moving forward. Fridays have normally got lunches getting prepared and and other things that are taking place.
Pub visits.
Pub visits,
Pub
which
visits,
are very
yeah.
important as journalists. That's where we do most of our work, is in the watering holes. Thanks for tuning in, everyone. Remember to check out smartpropertyinvestment.com.au. Lots of other podcasts on this network. Go and tune into them. Social media, you can track us down. And please, one favour for me, wherever you're tuning into this, whichever podcast play, and or if you're tuning in on YouTube, like us, follow us, reviews, all that stuff is good. I don't ask for it a lot. To our detriment, I think, because we do perform really well across all the podcast charts, despite the fact that we get very few reviews. So I think that may change things for us pretty rapidly. So if you can do that, I'd appreciate it. We'll see you again next time. Until then, bye-bye.